in your lifetime. So we really want to make sure that you're prepared to go out there and take that next step when the time is appropriate. So a little bit about me. So I'm the branch manager of American Pacific Mortgage. And we have a little bit of a unique approach in that we do educational workshops throughout the country. So this is actually one of our first workshops that we're doing on the East Coast. So we're really excited to be in Virginia. Primarily, we do these workshops across the West Coast, but Virginia is our first opportunity to help our community out there. And so I've been in the business for about 20 years. I specialize in first-time homebuyer programs. You're going to learn a little bit about some of the Virginia-based first-time homebuyer programs that are available to you. Now, if you're joining us from other states outside of Virginia, we can certainly talk offline about some of the first-time buyer programs for those appropriate states. You know, most of our focus tonight will be kind of in general what it looks like from a first-time homebuyer perspective. And so beyond some of the first-time homebuyer programs, we're going to spend a little bit of time looking at conventional loans, FHA loans, VA, USDA loans, and like I just mentioned a few minutes ago, some of the down payment assistance programs offered through the state of Virginia. So here's some of our talking points for this evening. As Booth mentioned, we're going to take all of your questions at the end of today's discussion. Usually we will make it an interactive session, but for the timekeeping perspective, we're going to go ahead and answer all of your questions at the very end of tonight's discussion. So if you do have something that comes up as I'm rolling through tonight's slides, feel free to put your question in the Q&A box, and then we're going to go ahead and tackle that at the end of today's discussion. So let's look at what some of our talking points are for today. So we're going to look at the housing market. We're going to kind of take a look at what we've seen in trends across the market. And of course, depending on where you're living today, those markets may look a little bit different, but from, you know, all in all, we'll kind of give you a sense of what we're seeing in trajectory in the markets. We're going to spend some time looking at, does buying make sense? Look at some budgeting. We have a really cool calculator that we're going to take you through. It's a rent versus buying calculator. And then we're going to transition from there to look at credit and how does credit influence your buying and your purchasing power. We're going to talk a little bit about student loans and obligations around that. We'll look at loan programs like I just mentioned a bit ago. And then we'll just spend a brief minute looking at income and some of the documentation that you're going to need for taking the next steps in home buying. And then we'll also look at those down payment assistance programs. And then I'll wrap up tonight's discussion looking at the loan process, as well as what a consultation looks like. And really the loan process, we've kind of really boiled it down and really simplified it into what we call the 6 steps of home buying. So what does it look like to be pre-approved for your home purchase, so you really know what your financing looks like, all the way to the very end of the process, which is step 6, when you get the keys to your house. So a lot of great things to share with you as we roll through tonight's discussion points. So let's go ahead and jump right in. And when we think about home buying, like I mentioned earlier, it's probably going to be one of the largest investments you make in your lifetime. And so for those of us that are joining tonight's discussion, you're maybe renting or maybe living for free at home. Maybe you have a roommate or something, and you're trying to just figure out what home buying could look like for you in the future. And so the fact that it is going to be probably one of the largest purchases you make in your lifetime, it's really important that you're doing things like this evening's session is going through your discovery to figure out what it could look like for home buying. And when we think about purchasing a home, there comes with it a lot of great benefits still. So you create stability in your housing budget. This is an asset that you have the ability to be able to pass along to the heirs of maybe the estate, of your estate, I should say. And there's potential growth in equity in your home. So when you own a home, the amount that you owe on your balance versus what the house is valued at, that difference is what we call as home equity. And that is an asset as well. And, you know, with home buying, there still is potential tax benefits. Even though there was some tax changes in 2018, you still have the potential tax deductibility of interest with owning a home. And so as we prepare to buy, we have a really great calculator that we use, and it's through the Freddie Mac website. And then I'm going to walk you guys through this evening. And it kind of looks at what does renting look like for me today in my current situation. And we'll do a what if scenario with this calculation versus what it could look like for me with the expected purchase. So I'm going to go ahead and drop into this calculator and kind of walk you guys through it. I think we're okay with our screen, Ken, for our screen sharing. So let's kind of look at this calculation. And by the way, I think Booth mentioned it to you earlier, but all of our material and the recorded version of this video is all going to be available to you. But we do like to send out all of our material from our presentations. That'll include the link to this calculation. Okay, so let's take a look at this. And I'm just going to kind of plug in some numbers here. We're going to assume for this discussion, we're going to put rent at $1,800 a month in rent. I know that it varies based upon where you're located, but we're going to say $1,800 a month in rent. For renter's insurance, we're going to put $15 a month. And then we're going to put our expected rent increase to be 3% on an annual basis. So as I renew at my lease, then, you know, expected the rent would rise by about 3%. Now let's compare that to a home purchase. And I'm going to go ahead and push this down a little bit. We're going to say like a $350 purchase price. Okay, we'll make that a little bit more realistic. And then the minimum down payment at a purchase price of $350 is 3%. Okay, and we're going to spend some more time talking about loan programs in just a bit. But assuming a 3% down payment, taxes will vary based upon where we purchase. I'm going to, for our discussion this evening, I'm going to put $4,250 as the annual tax basis. Homeowners insurance. So homeowners insurance is going to protect our home against different perils, theft, vandalism, fire. So I'm going to put homeowners insurance. I'm going to put it about $800 a year there. Okay. And then maintenance, we also want to budget that in because obviously as a homeowner, no longer can we contact our landlord and say, hey, I don't have hot water. I need to get my hot water heater fixed. Now we're going to have to obviously put or outlay that expense on our own. So let's put $2,000 as annual expenses on our budget side there. Okay. And then the next tab is loan information. For this discussion, we're going to put a 30-year fixed mortgage in. We're going to enter an interest rate of 4%. And by the way, we're going to talk a little bit about interest rates this evening too, because that's a lot of what's going on in the market and how that's affecting purchasing power. So we'll look at interest rates. Origination charges are going to be what your lender costs are going to be. And so for the origination charge, usually lenders will have a processing fee, an underwriting fee, and some other miscellaneous items. With American Pacific Mortgage, we usually have a $910 processing fee. That gets dropped down to $160 with our VCU affiliation. And then there's also an underwriting fee, which is $995. Now, when you purchase a home, there's a thing called closing costs. So we're going to have to save up our down payment, plus we're going to have to save up our closing costs. And so if you see under this section here, we have other settlement charges. So that's where we've kind of added in those additional closing costs to expect. And then the last assumptions we want to make is appreciation rate for our home. And then you can change this based upon your own personal calculations, but we're going to put 7 years that we're going to be in the house. The cost of selling the house. By the way, when you have a realtor that represents you, that's not an outlying closing cost that you'll pay for as a buyer. And then you'll have state and federal tax rate and then the savings rate. So what this calculation says to us is that if we stack side by side our rent situation versus what it could look like in buying, and I do it for the next 7 years, now my payments on a rent standpoint are going to be about $1,800 a month, as we know, right? Now, and I compare that to a $350,000 mortgage payment, that's going to be about $600 higher. That pushes me closer to $2,452 per month. But when I kind of put side by side the opportunity cost over 7 years, it's about a $66,000 opportunity. So when I factor in the tax benefits, the equity appreciation over the 7 years compared to continually paying rent, that opportunity is about $66,000 at the end of 7 years if I decide to sell my home. So clearly a great investment. Now, does the math always work that favorable for everyone? No. But it just gives you an idea of what it could look like if I was to pay that $1,800 in rent versus what it could look like in my home buying situation. Okay, so that's our rent versus buying calculator. And I really encourage you, if you get a chance to work on that yourself and kind of do your own personal calculation, I think that'd be super helpful for you. All right, so let me go ahead and drop back into our slideshow here. Okay, so let's talk a little bit about the housing market. Depending on where you're located, you're probably seeing various levels of home appreciation. And, you know, Virginia is no different than other parts of the country that we've seen massive appreciation. And you really, if you look at this line here, that represents the start of the pandemic, we really saw a swift move in home appreciation. What led to that was limited inventory supply, obviously much lower than expected interest rates, moving as low as 2.625 at one time. We're going to spend some time looking at rates in just a bit. But also, as we've seen, you know, our work environment has changed a lot. So the buyer demand to be able to find a house and have something where they can set up shop and work at home looks a lot different than it did pre-pandemic. And so those factors really led to an increase in home appreciation. You can see just this kind of massive move upwards. And if we were kind of to push this further out across 2022, we have seen still a steadily incline in appreciation, but we're starting to see a little bit of a crest in certain markets. That bodes very well for some of our expected first-time home buyers that are going to enter the market. With limited inventory comes multiple offers. And so if we have just a certain amount of inventory on the market, but we have a high demand, that the old supply and demand, limited supply, high demand, that's going to push up prices, but also makes it super competitive too when we're out shopping for homes. Hopefully we'll see that settle down a little bit, especially with what's going on in the interest rate market. And speaking of interest rates have really kind of risen up over the last, we'll say about month. Interest rates a month ago were running right around 3.5, maybe 3.625. Today, the average interest rate is just cresting over about 4%. And so the market remains really volatile right now. Inflation is really putting a kind of a big hurt on the market. The Federal Reserve has already kind of indicated that the federal funds rate is going to go up 0.25% in March. We could see that go to 0.5%. So it's really kind of a TBD at this point, but the market remains very volatile with interest rates. At the same time, I think the interest rate movement we've seen upwards is also encouraging buyers maybe to move a little more swifter when it comes to taking that next steps towards homeownership. If we kind of step back a little bit and look at the market from an interest rate perspective, I kind of described this already to you, but really right here over the last month, we see this kind of swift move upwards on the 30-year fixed mortgage. But at right around kind of the end of 2021, we saw rates dip as low as 2.625%, which was an incredible opportunity, especially for existing homeowners that were trying to take advantage of those lower interest rates to reduce their payments by taking advantage of a lower interest rate. As first-time home buyers, many of you got a chance to take advantage of that as well. And I still think even with rates moving into the 4% range, still presents a huge opportunity for us first-time buyers as we enter the market. We may just have to recalibrate either our purchasing power or kind of really our interest in certain properties. Now, I think, as we look at the housing market, and if we can see that the housing market kind of crest a little bit, and maybe kind of slows down, if prices start to soften a little bit, hopefully that'll make up for some of the losses that we've seen on the interest rate side. Now, for those of you that are doing your kind of investigative work with interest rates, it's not hard to just Google interest rates and you'll probably get many different solicitations that come to you, and you'll probably start to see things pop into your email and whatnot. But interest rates are a little bit different for everyone. They're different from a credit perspective. So depending on what my credit score looks like, depending on the loan program I select, how much I finance, what my down payment looks like. And as I select my interest rates, there's a cost structure that you can have in selecting a certain interest rate. That's also known as points. So when you Google interest rates and you get a solicitation that pops up and it says, hey, you know what, here's a 2% interest rate. Probably that 2% rate doesn't exist without paying a significant amount of cost, especially if you're learning today that interest rates on average are about 3.8 to 4%. Clearly, there's going to be some cost to be able to achieve that level of interest rate. And so we need to be careful as consumers as we look at different lending options to make sure the rate is truly what is being described to us. Because what's said over the phone versus what is shown on paper can look like two different options. So we really want to be careful with that. Now, what are points? Points are going to be a cost percentage of your loan amount that achieves a certain level of interest rate. So for example, if I'm going to get a 4% interest rate today, and that has no points today, maybe I can pay a point, which a point is 1% of my loan amount. And maybe that point can pull my rate down from 4% down to 3.75%. And obviously having a lower interest rate gives me a lower monthly payment. But from a cost perspective, it does increase my overall closing costs. Terms can also impact your interest rate. So generally speaking, there's a few different terms that we would look at. So a 30-year fixed mortgage, 20-year, a 15-year fixed mortgage, and then a 10-year fixed mortgage. Those are all usually the general options that buyers will take into consideration. Obviously, the lower your term that you have, you do get a potentially lower interest rate, but you're going to have a much higher monthly payment. For most of our first-time buyers, we're going to select a 30-year fixed mortgage just because it makes more sense from an affordability perspective. So that's generally what we'll be looking at. Most of our first-time homebuyer assistance programs that we work with are going to be around a 30-year fixed product. Now, one of the things you're going to hear from us as we go through tonight's discussion is, this thing around consultations. And so what we like to do is meet one-on-one with our clients as we build a home buying game plan for them. And one of the things we do in our discussions is to build that plan, but also talk a little bit about eligibility for programs, interest rates, cost structures, all that stuff. So as you begin your journey towards homeownership, you really have a great understanding of what the financial options look like for you. And so that's one of the things you'll probably hear from us as we go through tonight's discussion. Now, in building your financial home buying game plan, we do take a look at credit, and credit's going to be a really important component of designing your financing, because credit can dictate which product option you have, could also, as you learned just a little while ago, have an influence on your interest rate offering. Generally with products, you're going to have a minimum credit score. So for an FHA loan, it's usually anywhere between a 580 to a 600 minimum credit score. Conventional loans are 620. VA loans are also a 620 minimum. And then for the Virginia Housing Conventional Loan Program, it's a minimum credit score of a 640. Okay, so it's really important that as we're preparing to buy, that we really have our credit in order, or at least try to optimize our credit score so we're in the best possible position to get the cheapest available financing. And by having the cheapest available financing, that increases our purchasing power in the marketplace. It's really important to kind of understand how FICO scores are calculated. So I just want to kind of walk you through this slide that kind of shows you the weighting of credit scores. So 15% of the credit model is how long I've had credit. So the longer or more mature my credit file is, potentially the higher my credit score is. 20% is going to be how long I've had credit in use. But also new credit that I've added to my report. So if I opened up 2 or 3 accounts in the last 12 months, that's probably going to put a little bit of a drain on my credit score. The other component of that is credit inquiries, namely hard inquiries. So hard inquiries are when you have a creditor that tries to access your credit file, that puts a hard inquiry on your credit. Now, when you're applying for a mortgage, even an auto loan, you do have a 30-day window of time to shop with as many lenders as you want. And that's the equivalent of 1 credit inquiry hit to your score. So if you do an inquiry today, that starts day 1, and now you have a 30-day window of time to apply with as many creditors as you want. It's the equivalent of 1 credit inquiry hit to your score. Now, as part of our consultative process for you, we're only going to start with a soft credit pull, and that's a little bit different because the soft credit pull does not impact your credit score. We still get to verify your credit score through Equifax, but just to really get a sense of your monthly obligations, what your Equifax score is, we start with that soft credit score. So in use and new credits, 20% of the weighting, 30% of how much I owe, and that's better kind of characterized as credit utilization. So that's basically my credit balances versus my credit limits. So if I owe, let's say, $5,000 in credit balances and I have a $10,000 credit limit, then I'm at 50% utilization. Now, ideally, we want to have that utilization number be below 10%. So in my scenario here, I'd probably want those balances below $1,000. However, not all of us are in that position to be able to have that low of credit balances. But if you're running 80%, maybe 90% utilization, so now I have balances around that $8,000 to $9,000 level, we really want to do our best to try to reduce those balances down below $5,000, kind of as a starting point. And then if we can get to below $1,000, that's going to be super helpful to try to help maximize that credit score. One quick tip for you on utilization that really helps a lot of our clients is that when you're trying to manage your credit card balances and you're trying to pay them down or maybe pay them off in full, try and do that before the end of your billing cycle date. So usually on your credit cards, there's a billing cycle date, but there's also a due date. So if you've gotten in the habit of maybe paying them off or paying them down on your due date, that's great. However, the credit bureaus pick up the balances at the end of your billing cycle date. So if my billing cycle is on the 20th of the month, but my due date's on the 4th of the month, even though I'm paying off the card on the 4th of the month, on the 20th, that balance was $4,000, so that gets sent out to the credit bureaus. So if possible, try and pay off or pay down that $4,000 balance before the 20th, because whatever that balance is after you made that payoff or pay down, that's what gets reflected on the credit bureaus. Okay, so that's just a way that you can help kind of optimize your credit score. Now, the last component I want to go through is payment history, and that's kind of self-explanatory. The better I pay on my bills on time, the better my credit score is going to be. But that's the biggest part of the weighting. It's 35%. Usually there's, or not usually, but the delinquency dates are based upon 30-day delays, 60 and 90-day lates. So anytime you're over 90-day lates, that's obviously going to put the biggest hit to your credit score. Usually the bureau is going to be looking at credit history from the last 12 to 24 months. One question that comes up quite often in our consultation is, Jason, what score are we looking at when it comes to qualifying me for my mortgage? Now, if you're applying individually, we're going to look at the middle score. So if I have a 700 score, 720 and 680, we're going to take the 700 for qualifying. But if I have a partner that's also going to join me on the application and that partner is at 760, 740 and 720, even though their middle score is a 740, we'll still have to use my lower middle score of 700 when it comes to qualifying. So individual middle score, two applicants applying together, we take the lowest middle score between the two borrowers. Last thing just want to kind of touch on here before we move on from credit is account closure. And this one gets, I guess misrepresented at times where clients are trying to do balance transfers or whatnot just to get better perks on a certain credit card. But you want to be careful with that because the previous card that you've had, maybe it's your longest standing credit line. If you close out that credit line after you've made the balance transfer, when you close out the account, you're losing all that great history from the credit bureau. So when it comes to the weighting of the length of credit, once you've closed out that credit card, the length of history gets impacted. So you want to be careful before you make a balance transfer that you're not actually hurting your credit score by opening up a new account and then closing out the old one. When it comes to kind of challenges on your credit with past late payments or whatever, this is a matrix to show you how long they'll generally stay on your credit report. So hard inquiries will be there for at least 2 years. If you had late payments, they'll be on there for 7 years. The impact to your credit scores in the last 12 to 24 months generally. Public records like bankruptcies, tax liens, those are going to be 10 years or less. And then if you have any federal debt, those can stay on your credit report indefinitely. So something you really want to address if those appear on your credit report. Now, for those of us that maybe have student loans that are still outstanding, and maybe need those to get through your education, student loans do come up as part of the consultation process. And so what I like to do is, as we're teaching these various classes, to kind of talk a little bit about, as lenders, how we calculate student loans, because it's going to be important for you in budgeting for your home purchase. Generally speaking, for first-time homebuyers, there's two kind of paths we go down for first-time homebuyers. It's either a conventional loan or an FHA loan. And with conventional loans, there's a bit of a different interpretation on the student loan calculation for indebtedness versus the FHA loan. So with a conventional loan, let's say I have $75,000 worth of student loan debt. If I'm on an income-based repayment amount, and let's say that amount's $250 per month, that's the amount we use for qualifying. Now, if you're in school, or back in school, I should say, in forbearance, and you haven't elected an IBR payment, then the default is 1% of your balance. So that would be $750 would be used for the qualifying. But if we have an IBR payment, then we use the $250 per month. That's with a conventional loan. With FHA loans, we'll take that same $75,000, but the default now is 0.5% of the balance. And that is used as the monthly payment for the calculating for qualifying. Now, you can also be on an income-based repayment amount. It just has to be greater than 0. So like in this scenario here, we have on the slide, if it's $250 per month, that's what we'll use for the qualifying. Now, just to kind of reiterate, if you're in forbearance or you're in deferment because you're back in school, we still have to count a minimum payment against the qualifying. Okay, we're going to talk a little bit now about loan programs. And these are kind of the 5 core products, if you will. There's, of course, many different other products, but we kind of want to focus in on a few of these core products when it comes to our first-time homebuyer classes. Usually, like I said, it's going to be the conventional and FHA loans, but we do offer also our VA loans for our veterans that have served, the USDA loan. We have a jumbo loan. That's generally going to be for our clients purchasing with financing above $647,200. Those do require a slightly higher down payment. And they also have a thing called reserves, where we have to not only save up our down payment and our closing costs, but we also need additional money set aside to be able to have those reserves in asset. Usually has to be either in a liquid or secured form. So what reserves would be the equivalent of is, let's say my monthly payment's $4,000 a month on my mortgage, and I have to show 12 months of reserves. That means 4,000 times 12 is $48,000 a year. I would need to have that in assets in addition to my down payment and closing costs. Not typical that our first-time buyers are going to need a jumbo product, just because it might be a little higher on the budget scale, but that just gives you a sense of what the jumbo loan could look like. I want to focus more of our attention on the conventional and FHA loans, because really that's about 98% of our first-time buyers going to be utilizing one of those products. With a conventional loan, like you just saw in our credit slide, the minimum credit score is a 620 with a conventional loan. FHA, it's a little bit lower at 600. We can also go down to a 580 credit score. The minimum down payment for conventional is 3%. FHA is 3.5%. So the way conventional financing works is, so we have the maximum loan amount of $647,200. So we just can't finance more than that amount, because if we go beyond $647,200, then that becomes a jumbo loan. And as we've learned just a minute ago, that increases the monthly down payment and some of the asset requirements. FHA, minimum down payment of 3.5%. Now, those funds can be either from funds that you've saved. They can also be from gift funds. There is no minimum borrower requirement out of pocket. And so that's useful with those products. Now, with conventional loans and FHA loans, there's kind of a big distinct difference when it comes to mortgage insurance, also known as PMI, or private mortgage insurance. So PMI comes into play when we put less than 20% down to purchase our home. And with conventional loans, there's a few different ways that we can pay our PMI. It can be monthly. We can split the MI between a monthly premium, plus we can pay some of it up front. We can pay all of it up front, which buys out the MI, but you can also elect a higher interest rate to be able to do what we call as lender paid MI. For the most part, the most typical way, I guess, that first-time buyers are going to pay for their MI is going to be with a monthly MI. That's usually what happens. Now, mortgage insurance, very much like interest rates, has different premiums based upon your credit score, how much your down payment is, and then how much you finance. So, when we think about conventional mortgage insurance, it will vary based upon those three factors. Now, mortgage insurance on a conventional loan generally has a cancellation option. So once I have 2 years in that original loan and 20 to 22% equity in my home, I can apply to have the mortgage insurance canceled. If you don't meet that criteria, usually the mortgage insurance will fall off around the 10 to 11 year mark on a conventional loan. So at the bottom slide here is just an example of what mortgage insurance could look like on a conventional loan. So if we assumed maybe a purchase price of $300,000, loan amount of $291, and credit scores of 740, and I'm putting the minimum of 3% down, my mortgage insurance is probably going to be $97 or so per month. So that's what that would look like. Now, I will say, in talking with clients, some of your online calculators, like through Zillow, Redfin, the mortgage insurance, from what I've heard, doesn't calibrate correctly. So I hear much bigger numbers. So I think that's just more of a general mortgage insurance. But when you actually go through financing and as part of your consultation, we'll walk you through exactly what your mortgage insurance expectations is going to be. So that's what conventional mortgage insurance looks like. FHA mortgage insurance looks a lot different. And while we have the lower credit score requirements, the mortgage insurance can be a lot more expensive with FHA. Usually the monthly mortgage insurance is going to have a 0.85% factor. So it's taking your loan amount times 0.85%, but there's also additional upfront mortgage insurance, and that gets financed into your loan, but it still is an additional cost that you have with your financing. Now, with mortgage insurance on an FHA loan, it does not have a cancellation option. So whether you have 10 years in the loan, a lot of equity, the only way we can cancel mortgage insurance is if we refinance out of the loan. Now, if you do decide to put 10% down on an FHA loan, it does have a cancellation option at the 11-year mark. But for the most part, clients that are going to elect an FHA loan are going to probably put the minimum of 3.5% down. The mortgage insurance on an FHA loan, as you can see here, if we bought the same house for $300,000, financing is going to be a little bit less because it's a minimum of 3.5% down. But the mortgage insurance jumps up, it almost doubles to $208 a month. And then we have the upfront mortgage insurance that would get added into your amount finance. So when you kind of hear the explanation of both products, you're like, well, why would I go with FHA if it's a lot more expensive? Well, there's a variety of different reasons. FHA is a little more lenient, obviously from a credit perspective, also from a guideline standpoint. So whether you've had a past bankruptcy, maybe some challenges with a foreclosure, or maybe a short sale, maybe some recent late payments, FHA will be a little more lenient around that, where conventional has longer seasoning periods. For example, FHA only requires 2 years out of a bankruptcy, where a conventional loan would require 4 years out of a bankruptcy. So little kind of nuances like that within the guidelines may direct a client to go with FHA or a conventional loan. And that's something, as we build your home buying game plan, that will help you kind of better understand what could be the best potential fit for you. So the conventional conforming limits are 647,200, and that's also for FHA for these counties. Now, when we go into higher cost of living counties, you can see, Fredericksburg or Falls Church, they go up to 822,375. So that's what we call as a high balance loan. If you're in one of those counties, and we'll put Arlington and Clark in there as well, and Fairfax, so that goes up to 970,800. But once you go beyond 647,200 in loan amount, the minimum down payment jumps from 3% to 5%. So it's still designed for first-time buyers or even second-time buyers, but the minimum down payment is from 3% to 5% on a conventional loan. FHA, it still stays at 3.5%. So just to kind of just circle back to that again. So up to 647,200, 3% down. Once we go beyond 647,200, and we're going into any of the counties that allow you to go up to 822 or 970,800, then that minimum down payment jumps from 3% to 5%. Okay. All right, so that's a little bit about loan programs, and part of our designing your home buying game plan is just to figure out what some of the best solutions are for you, and have that be a part of kind of designing your overall budget for your home buying. In designing a program for you and kind of looking at your qualifying, we have to look at what your income looks like. Usually there's a few different factors when it comes to qualifying for your mortgage: credit, assets, income. And so income is one of the big components. And the documentation required usually for a W-2 wage earner are going to be your last 2 years of W-2s, last 30 days of pay stubs, and then we're going to have to verify your employment in some form. Now, for self-employed individuals, it's a little more complex, depending on how your tax structure is. Usually it's the last 2 years of taxes. We'll also need a profit and loss statement as well as a balance sheet. And then we'll have to verify the business, whether through like a CPA letter or a business license, something of that nature. Some of the questions we get when it comes to qualifying income, and I want to kind of share those with you, because one of the things we get often is, Jason, do I have to be on my job 2 years to be eligible for financing? And actually, we just need to verify 2 years of work history and or education. So the example I'll use is, let's say I graduated from VCU with my accounting degree in the fall, and I just started my new job at an accounting firm. And the fact that I went 4 years at VCU and now I'm working in accounting, that would fulfill my 2-year requirement because I have 4 years of undergrad, plus now I just started my job. So then we could use your current income for your accounting position. So that's kind of a big misconception that we hear out there, is I have to have 2 years on my job. Other thing we hear is that, if you started a new job, you transition, you have to wait 6 months before you can use that income at the new job. So if I'm now in the workforce for 2 years and I've switched over and I'm going to go to a different job, as long as I can provide an executed offer letter, I can potentially use that new income for my qualifying. Now, if I have dual income sources, so let's say I have W-2 employment, but I am also maybe doing Uber on the side, I need to be able to demonstrate that I've done both my W-2 wage job as well as my Uber driving for 2 years consistently in order to use both sources of income. Let's say I'm in healthcare and I work at 2 different hospital locations. I work 30 hours at one, 20 hours at the other. If I want to count both streams of income for my qualifying, in that case, I also have to show that I've been on the job 2 years consistently with both positions. Okay, so we'll help you through the documentation that you'll need. It's pretty self-explanatory, but as part of your review for your consultation, we'll kind of walk you through all the pieces of documentation you'll need. Those can be easily uploaded through our portals that we provide to you in advance of your consultation. Staying with kind of income, there's a calculation that we use as lenders. It's called debt to income ratio. And what it does is it takes your pre-tax income versus what your monthly obligations are. And we have a calculation that kind of tells us, what that qualifying looks like based upon those numbers. So if we look at a debt to income ratio, it's going to take into consideration your principal, interest, your taxes and your insurance on your new house. Now, if you're putting less than 20% down, we'll calculate the PMI in. And then for buying maybe a condo, townhouse, there might be what we call HOA dues or homeowners association dues. So we'll factor that into the monthly payment. And then we'll also look at your other debts like car loans, personal loans, credit cards, lines of credit, things of that nature. And in this scenario here, let's say I have a $2,000 a month housing expense and $500 in other debts. So that's $2,500 versus my gross monthly income of $7,500. So in that scenario, my debt to income ratio is 33%. The highest we really would want to see that debt to income ratio is 45%. So that's kind of really the max that we're looking at. Now, debt to income ratio is a qualifying tool for us as lenders. It's not an affordability tool. So as part of your consultation, we're going to talk more about what's the monthly amount look like, because of course, in our households, we all have different expenses that don't appear on our credit reports, whether that's, daycare expense, we could have entertainment expense, food expense, anything that we need in our households that we rely on daily. Those aren't factored into the debt to income ratio, but they are part of your affordability. So as we kind of go through your home buying game plan, we really want to understand what's the monthly amount that's going to make you feel comfortable with your new home purchase. These are some of the acceptable sources of down payment now. So as we're transitioning now, we're going to look at down payment in the assets that we need to verify through our home buying process. So checking and savings accounts, of course, those are all eligible. But we do want to look at the last 60 days of history in your banking records. So if you just recently made a large deposit for $10,000 and it's not typical from a payroll or anything like that, we're going to have to trace back where that deposit came from. Everything has to be sourced and seasoned for 60 days, unless it's a gift funds. And I'm going to talk to you about that in just a bit. Cash cannot be used in a real estate transaction. So everything has to go through a financial institution. Retirement accounts can potentially be used. 401ks, 403bs, IRAs. You just want to be careful with IRAs because they could have some tax consequence to them. And of course, with 401ks and 403bs, you're borrowing money from yourself, but you're pulling money out of the market. So you're no longer reaping the rewards of appreciation in the market. And then finally, gift funds. That's when a family member is helping you with your home purchase, whether that's designed for your down payment or maybe some closing costs. Gift funds do not require seasoning. So if you have a family member that's going to gift you funds today, that money does not have to be seasoned for the 60 days. Okay, so we're going to transition now and talk to you a little bit about down payment assistance. And through Virginia Housing, there is some down payment assistance programs that are available to you, and we can look at those as part of your consultation. And there's quite a few different products that are available through Virginia Housing. I want to just walk through a few of these today, and then, like I said, as part of a consultation, we can design more of a customized home buying game plan that fits. That is the best fit for you. So with the Virginia Housing Conventional Loan Program, so it's going to look and feel just like the conventional loans that we described earlier today, but it's going to require less money out of pocket. It's going to give you a little more flexibility when it comes to down payment options. You can also use gift funds, and there's a second mortgage product that's available. So what we can do is ultimately take the conventional loan, couple that with the Virginia Housing second mortgage, and reduce your total amount of money out of pocket. Because what we learned earlier today is that you have a 3% minimum down payment. That conventional down payment or minimum down payment still would hold true at 3%, but you would get assistance to help offset some of that. There's what we call a DPA, or down payment assistance grant, allows you to borrow anywhere between 2 to 2.5% of your purchase price. The nice thing about a grant is the grant does not have to be paid back. Whereas your second mortgage generally will need to be paid back when you either sell your home or if you refinance in the future. So let's take a quick look at what it looks like to maybe incorporate assistance into your home buying game plan. So let's say, for example, I bought a house for $350,000. My minimum down payment is $10,500. The closing costs generally, I always estimate anywhere between 2 to 3% of my purchase price. So let's say that's $7,000 to maybe $10,500. So if I take my minimum down payment here plus my closing costs, I'm probably going to need about $17,500 to maybe $21,000 out of pocket. For some of us, it's totally within our wheelhouse. It's right there, no big deal. For others, it might be a bit of a stretch to make homeownership more of a near-term goal. So when we add in, say, the Virginia housing plus second mortgage, we can still buy that same $350,000 house, but with our expected cash to close of $17,500, we can incorporate the second mortgage, and we can elect anywhere between 3 to 5% of our loan amount, and now take that cash to close from 17 to 21,000 and bring it down to maybe 7 to 10,000. And maybe doing something like that, that'll help us make homeownership a little bit more attainable for us. So there is eligibility requirements for the program, like other first-time homebuyer programs across the country. So there's a minimum credit score of a 640. The debt-to-income ratio cannot exceed 45%. And there is income qualifications based by county. And I think we're going to have those up on one of our slides here in just a minute. The maximum that we can lend is just like your normal conventional loan, which is 97%. And it also does follow those same conforming limits that you guys learned about earlier this evening. Both the grant and the second mortgage are available to only first-time homebuyers. So a first-time homebuyer is someone that has not owned in the last 3 years. So these are the income limits by county. So depending on where you're joining us, this is what the income limits look like for the program. With the program, generally, it's going to be based upon applicant income. And so, based upon who's applying for the financing, that income is what we'll take into consideration for these income limits. Okay, so that's a little bit about the Virginia Housing Down Payment Assistance Program. We're going to now spend some time looking at the process of purchasing a home, and we call this our 6 steps of home buying. So I want to walk you through what it looks like to go on the journey from pre-approval all the way up to step 6, to the closing of your home loan. And so the first step is going to be pre-approval. And actually, before we get to that step, we have your consultation. And so we design our home buying game plan. We look at our budget, we look at credit, we look at our income proof, and we just kind of get this comprehensive plan together. We figure out what our purchase price is going to be. And then the pre-approval is going to be the output of that consultation. And then once we get on that journey on the 6 steps of home buying, that's where we'll start with the pre-approval. So the pre-approval is usually good for 60 days. So if your home buying maybe your home shopping takes longer than 60 days, we can always recertify your pre-approval at any time. So it doesn't require our future homeowners to reapply or anything. They would just reach out to us and say, hey, I need to get my pre-approval recertified. It's been about 6 months, and we can easily do that. The pre-approval certificate shows the seller that you're eligible for your financing, that you've been qualified from a lender, and that you do have the available assets, credit score, and income to be able to afford that prospective property. So the pre-approval certificate can be adjusted as we go through this house hunting, because if we get pre-approved for $350,000, but maybe we find a house for $325,000, we can always adjust that pre-approval to match that offer price. So step 2 is going to be house hunting. And that's where you're going to generally connect with a realtor to be able to kind of show you some different options that are available to you in the marketplace. Like I just mentioned to you, we're going to generally match that pre-approval letter, or the pre-approval letter is going to generally match whatever your offer price is, just to help with negotiations. So, you just reach out to us and we can go ahead and update that pre-approval accordingly based upon what you do decide to offer on a home. Once you find that home that you decide you want to make an offer on, your realtor will help design that offer, put all the terms and conditions together for that offer, and present it to the selling agent. The selling agent is representing the seller of the property. If that offer gets accepted by the seller, then we're going to move to step 3, and that's called entering escrow. So that means we have a ratified agreement with a seller, and we've started this escrow process. And usually the escrow time period, it does vary by location, but usually it's 30 days. So from acceptance to when I actually get my keys at step 6, it's going to take roughly about 30 days. Now, at acceptance of offer, generally we're going to be making an earnest money deposit. That deposit is usually made within the first 2 to 3 days of the contract. And so that will usually be the equivalent of 1 to 2% of our purchase price, depending on what's agreed upon in your purchase contract. Within 24 hours of your acceptance of your offer, we're going to reach out to you, schedule you for your follow-up consultation, and kind of talk to you a little bit about what next steps look like. During that follow-up consultation, we're going to kind of go back through the design of your financing, make sure you feel comfortable with today's interest rates, payment, cost structure. We're also going to start some of our internal process of ordering your appraisal of your property and getting your realtor will generally order your inspections, and then we'll provide you your disclosures. During your follow-up consultation, that's about a 30-minute session, and we really want to make sure that you understand how everything is constructed with your financing, and then let you know what the next steps are going to look like. So those next steps are going to be step 4, which is processing and underwriting. That's when our team is going to verify employment, assets. We're going to just make sure all the documentation is constructed properly so we can submit you to our underwriters for your loan approval. By that time, we generally have your interest rate locked in, which is an important component, especially in this volatile market. Usually interest rates will be locked in to the equivalent of what your escrow time period is. So usually I would say a 30-day lock period. Depending if you're buying new construction, that might look a little bit different. And then at step 4, we'll be submitting everything to our underwriters, and the underwriters will issue the loan approval at step 5. Now, every state's a little bit different, but in general, there's going to be what we call as contingency periods that allow you to do your due diligence on the property. And so those timeframes may vary a little bit. But at step 5, we're going to issue to you a final closing disclosure. And as a lender, that gives you, the consumer, a 3-day cooling off period to make sure your financing is everything you expected. So there was no changes that were unexpected. So by the time you get to the very final stage, which is step 6, everything lines up with what you expected during the process: interest rate, payment, out-of-pocket expense. So we get to step 6, and that brings us to the closing of the loan. And that's when you're going to sign final documents, and that's generally done in person. Everything up to that point can usually be done via e-signature, but at step 6, everything's going to be done in person. Once you've completed the task of signing the documents with the public notary, you will wire in the funds for your home purchase, whatever that balance is that is owed in your transaction. Us as a lender will do a final audit of all your documents, make sure everything is signed correctly, dated correctly. And if that's all fulfilled, then we'll go ahead and wire in the funds for the financing. That money gets collected by an escrow company, and if everything checks out and all the audits are complete, then they'll release the documents to the local county recorder's office. And they generally record a grant deed to transfer ownership to you, and they'll also record a deed of trust, which is your agreement to repay the loan. And once we receive the confirmation of those things being recorded, then you'll connect with your realtor to get your keys to your home, because now you're the official owner of the home, and you get to celebrate and tell all your friends, post it on Instagram, and share everything about this big, huge milestone in your lives, really. These are some of the kind of the reference tools. I just want to kind of, I'm going to go and kind of move through them quickly, but you'll have those in your slideshow so you can see more about the contingencies, as well as more about, more about earnest money deposits, I should say. So you've heard me talk a little bit about consultations this evening, and after we kind of wrap up tonight's session, if you do want to schedule a consultation with us, just to schedule or to kind of figure out a home buying game plan, we'd love to be able to connect with you to do that. It's a really simple process. It's a free service we provide. That allows you to do an online application. You upload some documents, and then we meet up for either a phone or a video call. I really encourage the video because we get a chance to screen share and show you what your different options look like, and just kind of get a comprehensive plan together. If kind of going forward after today's session, you just have some questions, maybe some financial questions you want to run by us, we'd love to be able to connect with you for an introductory call, and we can just kind of go through your scenario. Sometimes it's about credit or maybe savings or how I'm going to, qualify with my income, and we can go over some kind of general questions that way. And then if you want to kind of transition to a consultation, that works too. This is just a way of us adding value to you and getting you on the path towards home ownership. Whether you're buying next month or next year, hopefully it provides you value so you can feel really comfortable. So when you do decide to take those next steps towards home ownership, you're really well prepared. This is the framework for a consultation. You've heard about it already. Understand your housing situation. We build that plan around budgeting, affordability. You kind of tell us a little bit about where you think about buying, because that's going to obviously drive a little bit of your price point. And then we'll make sure your application is accurate. We'll go through your debt to income ratio analysis, and ultimately walk you through the 6 steps of home buying, and then issue your pre-approval. So that's what that looks like as part of a consultation. And really, that's to add value to you and make sure that you really understand what direction you're going towards homeownership. We got some fabulous tools that are available to you. One of it is our mobile app, and you can download it right here. It's available for Android and Apple. You can even start your home buying journey and complete your application all through mobile and upload all your documents. As part of our VCU partnership, we're really excited to share with you our $750 closing cost discount. I think I mentioned it a little bit earlier this evening, which is usually we charge a $910 processing fee. That gets dropped down to $160 with our VCU partnership for all of our alumni, employees, any of our staff at VCU. We also have partnerships across the country in different markets. So if you're joining us from a different institution, we have a very similar discount, so you can check that out as well. These are free services we provide in these consultations, and so we really encourage you to take advantage of that. We do teach these classes every couple weeks for different markets. We also have different types of classes, whether it's for refinancing. We're going to be doing some different credit tune-up classes as well, so feel free to join us for those classes. You can check our latest classes out at mortgageeducate.com. So you'll see the list of the upcoming classes for 2022. And as I wrap up tonight, we understand, again, this is probably going to be one of the biggest investments you make in your financial futures, and we really applaud all of you for joining us for this session, because to take time out of your busy evening on a Wednesday night takes a lot of time and energy, and so to do that, to invest in kind of this big purchase you're going to make, I think is a big deal. So we appreciate you guys kind of carving out a little bit of time for us in your evening. So with that said, I do want to share with you my contact information. So if you need to reach me via email, call, I can take text messages, whatever's easier for you. If you just want to book an appointment just to kind of talk a little bit about your scenario, feel free to click on the schedule appointment here. We have all our social channels on this slide. So if you want to check out some of our fantastic testimonials, many of which are graduates from our classes that we've taught over the last 6 or 7 years, love for you to check those out as well. So thank you so much for joining us again. I'm going to turn it back over to Booth to wrap us up here.
Jason, thanks so much. That was awesome. I learned a lot. I have bought before, but I definitely learned a lot that I will use towards my next home purchase. And thanks for sharing with our alumni.
Absolutely. My pleasure.
Thank you to everybody who joined us this evening. I hope you enjoyed the conversation from Jason. We are going to be sending out an email in the next 48 hours with both a link to the presentation that you saw tonight, and then also a quick survey that we would love for you guys to all fill out that will help us make future events, future alumni events going forward even better. So we would love to hear your feedback on what you thought of tonight's event and ways that you'd want to improve or different things you want to see. So be on the lookout for that. Also, if you're interested in attending future alumni events, I'm going to put a link to our calendar in the chat box so you can check out what we have coming up in the next few weeks. We will have Jason and his team back next quarter to talk about a different topic, most likely. So be on the lookout for that again, whether it's like you mentioned, or maybe credit, how to improve your credit. We will have him and his team back again next quarter to do the same thing. On behalf of VCU's Office of Alumni Relations and American Pacific Mortgage, I just want to thank everyone again for coming out tonight. If nothing else from Jason, I think I'll wrap everything up and let you guys enjoy the rest of your evening.
Okay, awesome.
Cool.
Nice.
Enjoy, guys. Enjoy your evening.
Good seeing you. Okay, bye-bye.